Martingale systems. What are they, and should we use them as a forex trader? That's what we're going to find out in today's episode. Hello everyone, and welcome back to the channel. So the reason we're going to go over what a martingale system is and should you use it is because we as algorithmic traders know whether this is a good approach or a bad approach. Now, if you ever go on the MQL5 marketplace because you're looking for an EA yourself or a system to follow, then you'll find that majority of the EAs or algos on that marketplace either use a grid system or martingale. So we're going to share our views on whether you should be using this sort of management style long term. So martingale strategy, what is it? Well, it's a popular betting and trading strategy that originated in roughly the 18th century and is based on the idea of doubling your bets or investments after a loss in order to recover the losses previously and make a profit. So in the context of trading, it's basically a martingale strategy is involving increasing the size of your trades every time you have a losing trade so that you can cover the last loss and make a small profit or reasonable decent profit. Now, while that might seem appealing, martingale is really not a great way of going about it as there is no guarantee of winning. Now, from my experience over time, we have seen that losing streaks can happen, and if you're using a martingale system, it's only a matter of time before you blow up your accounts. Also, with a martingale strategy, it can always seem like you're always winning because you'll go through lots of periods of recovering and then constantly winning. But there will be times where you will hit drawdown and you really don't know when your time is up. So there's a lot of psychology pressure that can come onto that as well. So let me jump on TradingView and I will give you an example of what martingale strategy looks like. So we're now on TradingView and I'll just quickly go through what martingale is. So let's say that we are a pattern trader and we're looking for either a bull flag or a bear flag. So we have an impulse up, we start seeing a flag, and at this point, this is where we're ready to get into the market. So we will buy here, we'll try target the high, and let's just go for a 1-to-1. Right. So this is where we first get into a trade. Now, let's say in this instance we risk 1%. Well, market comes down and hits our stop loss. So that's our first losing trade of 1%. Now let's say, we still think that the market's going to go up. So we go along from here again. Now, the difference here is with a 1-to-1 basis, we will be risking 2% because we want to recover our 1% loss and make a return. So you'll then risk 2% in this trade. And again, market comes down, so we take out another loss. Now, let's say we think the market's now going down. Well, it's producing a bear flag. So at this point, we want a place to sell, stop, say like here, and again, targeting that 1-to-1. But instead of risking 2%, we need to double and risk 4%. So again, say we are taking out for stop loss. Well, that's now overall, we have lost say 7% of our account in free trades. So again, we still think that the market's going to go down and we risk again, 1-to-1. This time, instead of 4%, it's going to be 8%. And you keep going through this repetitive cycle basically until you either get a win where you will recover your losses and make your money, or your account basically goes blown up. So that is the basics of what martingale strategy is on a chart, and we'll now jump into why you should definitely not use this
as a risk management system.
So the main reason as to why you should not use Martingale is over the long run, you will come into a period of severe drawdown. And the reason behind it is, as explained previously on TradingView, every time you have a loss or you hit that sort of 1% loss, but you don't close it, you then double your position size and you keep going until that you have a winner. Now, this may work a lot of the time, which is why if you find a system that has a high strike rate, most likely it's using Martingale. But it's only a matter of time before they hit that sort of losing period, and I can tell you from experience, losing periods come and they happen probably a good couple of times a year. Once that period hits, that's when the system can seriously take a huge hit or chunk out your portfolio, or even at worst case scenario, potentially blow up. Now, here at Satira, that's exactly why we risk low. So we risk roughly 0.3% per trade. And this is just so when we do hit a losing period, that it doesn't have a massive hit on us. And psychologically, that is much better if you want to continue trading, because you'll have peace of mind that even after a big losing streak, you're not really going to have a massive hit. Now, if you are looking for a system like this, then please hit the link in the description and you can look into it yourselves. And that brings us to the end of this video. Now, if you have enjoyed this educational video, then please give the video a like, as it helps us with the YouTube algorithm. And if you want to see more videos like this, then please subscribe to the channel. We upload every Wednesday and we hope to bring value to any of you beginner or even advanced traders out there. But thanks very much for watching, and if you watch next week's video, we'll see you in the next video.